We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrick. Joining me today is Don Durrett, author of How to Invest in Gold and Silver. He's also an investor and contributor to Seeking Alpha, and his main focus is goldstockdata.com. Thanks for joining me today, Don.
Hey, Tom. Thanks for having me on.
So recently you wrote in your February newsletter that you think the gold price is headed lower yet rather than higher. So how much lower do you think it can go, and what factors are really going to push us even below the 1724 level?
Well, the problem with gold is it's what I say, it's trapped right now. That's why I say it's probably going lower. And what I mean by trapped is that we have a risk off trade right now where everybody wants to invest in stocks and nobody wants to invest in gold. So there's no driver right now to really push gold higher. And when I say driver, I'm talking about like the big money. The big money isn't ready to change their mind on where they're putting their money. So right now they're basically putting it into stocks. And, today we had the Dow up 600 points. So we have a continuation of this risk off trade. Everybody is very comfortable putting money in the stock market. So consequently, you're not getting, a lot of money into gold. And I've been saying this, gold's kind of been trapped for a while now. I mean, January and February. And as long as you have this strong risk off trade where there's really no reason to get out of the stock market and go towards more gold, it's problematic as a gold investor. So when I say trapped, it's like the other thing is that the markets are very heady right now. I would say I saw a chart this weekend that showed that we are as overvalued as any market has ever been. So the markets are getting ready to correct, in my opinion. I think they will correct either in the first quarter, before the end of March, basically in March, or in the second quarter. So if we get a correction in the stock market, it's very unlikely that gold gets a bid initially. So let's say the stock market sells off anywhere from 5 to 15%. In that scenario, gold's going to get hit. I just don't see gold getting a bid initially. And so from that perspective, 1720, 1700 isn't going to hold. My range is somewhere between, say, 1600 and 1650 is my expectations. I'm kind of crossing my fingers that we don't go any lower than that. I mean, it's possible we could if the stock market sells off 15%. But gold's going to take a hit here, I think, in the next few months because of that situation I just outlined.
Mm-hmm. And before the call, we were kind of speaking a little bit about how you look at things from both a technical and a fundamental perspective. So, Don, what are some of the, let's say, factors that you're considering that could cause that market sell-off coming in, let's say, March or April, as you're talking about?
So the Fed and the Congress has been moving towards MMT, modern monetary theory, since, say, 2007-8. We're kind of copying Japan. We're actually turning Japanese. It's kind of interesting. Japan in, I think it was like 2016, they basically pegged their 10-year treasury at zero interest rates. And they called that yield curve control. Basically, we're not going to allow the 10-year to go above zero. Mm-hmm. And now last week, the 10-year went to 1.5% and the Dow dropped 500 points. And everybody's freaking out because interest rates are going higher because of inflation and because of potential growth worries. So never before has the Fed ever tried to control or peg interest rates, at 5 or 10-year level. And now the Fed's, we're looking at, we're turning Japanese. Now we're going to do yield curve control. So the Fed is juggling. This is a very unusual situation. Last year, we had a $3 trillion deficit, $3 trillion. This year, we're going to have another $3 trillion deficit. The national debt's at $28 trillion. It'll be a $30 trillion probably by June. The Fed's balance sheet was at $4 trillion a year ago. Today, it's at 7.5. So the Fed add 3.5 trillion to their balance sheet. So this is MMT. This is basically saying that debt doesn't matter, that we can add trillions of dollars without consequence. Well, the Fed now is in a situation where they are becoming the de facto, controller of the economy. But not only that, they're becoming the de facto manipulator, controller of all of these policies that in the past, it wasn't their responsibility. Mm-hmm. For instance, now they have to control long-term interest rates, which they never had to do that. If they don't, if the 10-year goes to 4%, the U.S. government's insolvent. So you have all these risk factors that are in play. We have inflation. So we have MMT now is expanding the money supply at factors we've never, ever considered doing before. So if inflation starts going up, that's going to put upward pressure on interest rates. Everything's going to kind of tumble down. And the markets right now are valued as if everything is fine, that the Fed will be able to juggle all these balls in the air and we will not crash. It's just a scenario that's kind of make-believe. So I say what's going to happen is we are going to get trending higher inflation rates. We're not going to zero interest on the 10-year. We're not going to 1% on the 10-year. It's not going to happen. There's just too much pressure on the economy. Japan never had that kind of pressure on their economy, so they could get away with it. Also, they internally funded all of their debt. The U.S. government wasn't paying for the Japan's debt. They paid for it themselves. That's a big, big difference. The U.S. cannot really, we're going to try to print all this money, but people can see that this is a whole new game. I say that last year, 2020, was a transition point for the world's economy, for the U.S. economy. And now we're transitioning into a new era. And what does that era look like? In my opinion, it's an era where the U.S. transitions, we start turning and looking like Japanese, where our growth rate is 1% or less. Mm-hmm. So right now there's like 10 million people that are not working because of COVID. How many of those people are going to go back to work? How many small businesses are not going to restart? All of these things are going to come into play. How long do we have to, for instance, the moratoriums on evictions? How long is that going to continue? And when the moratorium comes off, how is that going to impact the economy? There's so many factors here that everybody seems, or the overall market seems to be ignoring. It's like blue skies ahead when in actuality it's a storm ahead and everybody has rose-colored glasses on and they can't see the clouds. So I think the second half of this year, so gold's trapped right now, but once the markets sell off and the fear trade kicks in and you get more people going towards buying gold and going towards bonds, and who wants to go into bonds or go into cash, that's more the risk off. I think I might have mixed my metaphors. We're currently in a risk on trade where everybody's buying stocks, high risk stocks. So we're going to go towards a risk off fear trade in the second half, is my opinion, and gold and silver, or the bull market will resume and we'll start trending higher.
So just to kind of crystallize that a little bit, Don, do you think that the Fed will come in and institute some type of yield curve control, and this will and could spur the fear trade in gold?
Well, those are two different things. I think that they're related, of course. Mm-hmm. I definitely think that the Fed has no choice but to do yield curve control and buy long-term debt. And they don't seem to have any qualms with doing that. But the problem, and this is where the fear trade does kick in, the problem is that they can't control inflation. They can buy the 10-year and the 30-year and lower the interest rates there, but they can't lower the inflation rate. So what you get is a negative yield, a real rate that's negative. And that's going to be very beneficial for gold. Simultaneous to that, that's another ball in the air that the Fed is going to have to juggle. So the market's going to constantly be thinking, how long can the Fed do this? How big is their balance sheet going to get? When does it become a problem? So that's what you were talking about. That's when the fear trade kicks in. The fear trade can kick in over a variety of factors. And that is one. Inflation rising is definitely a huge one, right? So if they start, negative yields, that's another one where it's not really the fear trade. People just buy gold because it's a negative yield. That's just kind of a technical thing. Mm-hmm. And that was one of the reasons why gold sold off here, is because we had the 10-year, which was negative, went down to, was like flat. Because the 10-year went to 1.5, and when the 10-year went to 1.5, the negative yield was kind of flat there. And that's why gold kind of sold off under 1,800. And so these technical things that are pushing gold are kind of ridiculous. When you look at the big picture, when you really connect the dots, it really doesn't add up. So I say that gold cannot stay under $2,000 very much longer. So even if it goes down to 1,600, it can't stay there very long because of all these factors, in my opinion. So I expect to be over 2,000 next year. Now, we could kick the can down the road. I mean, MMT, the markets could basically say, we don't have a problem. Now we have MMT. MMT is going to work. And we kick the can down the road for a couple of years. In gold languages, say under 1,900 or under 2,000. That's a possibility, but I don't see it happening.
Mm-hmm. So, Don, you wrote a new constitution to help fix some of these issues. Can you tell us about what some of your most important points are in that?
Oh, wow. I didn't see that question coming. So I'm a very politically oriented person. I always, since 1980, I started reading a lot on politics and became really interested in politics. And when I was in college, my teacher said, "Are you a poli-sci major?" And I said, "No, I'm not." He said, "Well, why not?" I said, "Because I couldn't be a Democrat or Republican. I disagree with both parties. I can't be either party, so how can I go into poli-sci?" So I never got involved in politics, but I did write a new constitution to give people ideas on how to reset society. So it's a complete new constitution. I wrote it from scratch. So I basically show how to set up the political system, how to set up the legislatures, how to set up the economic system, even how to set up the cultural system, how to do your, policing and all. I did the whole thing. And I wrote the Constitution for if a state secedes and they want ideas, because if a state secedes and creates a new country, they're going to have to create a new constitution. Mm-hmm. So that's what I wrote it for. I wrote it for people to have ideas to literally create a new country. And a lot of my ideas, it's not going to happen here in America. Nobody's going to adapt the ideas that I wrote in that book. That's not how Congress works right now. You'll notice we don't get change in this country, fundamental change. For instance, I'll just throw one political thing out there and then we'll go back into business. Donald Trump really missed an opportunity to get reelected and to get the country going in a new direction. And what he could have done is he could have basically changed the way that we do global trade in that, and instead of having this globalism free trade, because it doesn't work when you're at the top of the hill and you have the high standard of living, you can't have free trade. And that's what, Reagan started in the 80s with globalism and free trade. It's never going to work for the middle class. So our middle class is getting hollowed out. So basically the idea that Trump what he could have done is he could have required any company, and he could have done this by industries. I would have started with electronics and autos. Any company that imports an electronic device or an auto device into America, 10% or 5% of that product had to have an American part in it, or the part had, made in America. If he would have done that, the unemployment rate we would have not had enough jobs. So he would have had to limit that to he might have only done electronics, right? And there wouldn't have been enough jobs. But Asian companies would have had to build, dozens of plants in this country. And those plants would have all been paying $15 an hour or higher. I don't know why he didn't do that. It's a real simple idea. And the odd thing about it is we do that currently with NAFTA. In NAFTA, if you build a car in Mexico, it has to have a percentage of American parts. My idea is that you do the same thing with anything else, and that car gets imported back into America. It's the exact same concept we're already using. I don't know why he didn't do that. It was a slam dunk because he wanted to help the middle class, and that was it. That was the idea. Okay, now let's go back to business.
Well, when we could see any of these, let's say, countries or states kind of reset to this, could you see any of them backing their currency with gold, silver, or even Bitcoin?
Oh, absolutely. No doubt about it. As a matter of fact, Bitcoin is the ideal hard currency because it's basically liquid, right? Transferable, whereas gold isn't. You could back currency by gold. That would work. That's an option. But we have Bitcoin. It already exists. And Bitcoin is going to appreciate in value probably much more than gold. So if a country used Bitcoin as their currency, they wouldn't have to create the currency, first of all. The currency would already exist. The government could hold Bitcoin, which would basically give the government kind of a strong little bank account, if you will. And the government could borrow money against their Bitcoin. So in other words, their debt would basically be valued. So yeah, I definitely see a country using Bitcoin because it's very hard money. And yeah, I think that's coming. But yeah, in the Constitution, I talk about that, about the money supply. The key for hard money is you have to limit the growth of the money supply, which is what Bitcoin does. So yeah, we need a hard money system, no doubt about it. I mean, the history shows us this. For Great Britain, when it controlled the world or whatever, was the superpower of the world, their currency they didn't have inflation for like 300 years. It was unbelievable. And their life and everything was, going along great. So we don't have to have inflation. 2% inflation, this is kind of mind-blowing. If you have a 2% inflation rate, in 36 years, your currency value cuts in half, 50% loss in 36 years. And that's a good thing? Right now, the Fed wants 2% inflation. We lose 50% of our currency in 36 years. Who wants that? I mean, it's crazy.
Absolutely. So, Don, what about silver? Is there anything in your analysis of the silver squeeze movement that you think others have missed? And can we win this war against the banksters, as you call them?
Yeah, well, we're not going to win the war, but, let me explain exactly kind of what's going to happen here. There's not enough silver to go around between manufacturers and investors. Once you get an economic system that's imploding, because then people are going to run to hedges, and silver's a natural hedge. And once you get over $30 silver, that's when the retail crowd is going to show up. It's showing up early. It's basically showing up right now. If you want to get a 1,000 ounce silver bar right now, you have to wait a month. It's impossible to get one today. They don't exist, basically. You have to wait until it comes out of the ground. So we definitely have a silver shortage right now, but it's not severe yet. It's not to the point where, for instance, manufacturers, they have enough supply right now where it comes out of the ground, they can get it. But my point was that there's not enough silver for manufacturers and investors. Once the investors get, say, over 35%, once they get to about 35 to 40% of supply. So right now, supply is about 1 billion ounces a year. So of that 1 billion, if investors want 400 million ounces, you're going to have a shortage somewhere in there, somewhere between 350 and 400 million ounces. And believe it or not, that's how much physical demand they want right now. Mm-hmm. So you're going to get a shortage situation somewhere between $30 and $50 silver. I firmly believe it's going to happen. And once that shortage hits, kind of all hell is going to break loose. I don't know exactly what's going to happen. So if you look at the war, we're going to be winning those battles, for instance, because silver's just going to explode in value. Once you get that shortage situation, they're just not. Now, the one thing, they're going to try to control it through the paper market where you won't be able to find any physical. But the key here is when a manufacturing plant has to shut down. Every automaker in the world cannot make a car without silver. Every phone maker in the world cannot make a phone without silver. So you can imagine how many large corporations make phones and cars. So if one of those corporations has to shut down a plant, boom, you have a shortage. That's coming. That's going to happen. So that's where we win the battles. But the wars will be won by the governments, because once you have that type of scenario where you have shortages in silver, the governments will say that this is a strategic metal and we're going to outlaw ETFs. And right now there's about 1 billion ounces of silver in the ETFs. You got 600 million ounces in SLV, and you got about 250 million ounces in PSLV. So that's like 850 million right there. So they outlaw ETFs, you got 1 billion ounces is going to flood into the market. That's going to crash the price. And it's kind of been game over for silver investors. Now, that's my expectation. I'm just hoping that it doesn't happen until we get to $100 silver. So, I'm fairly certain that that's going to be the outcome. You can't shut down industry. You can't do it. It's global. So, the G7, it's going to be real easy for them to outlaw ETFs. So, sorry to scare everybody. But the good news is silver's going to run to 50 to 75 before that happens.
Right.
So, if you're in the silver miner space, you're going to still get your 3, 5, 10 baggers before that happens. You just want to make sure you take a profit.
Mm-hmm. So, Don, you were also saying that the silver squeeze doesn't really matter. It's gold that really matters. Is that right?
Gosh, you did your homework. Absolutely. Gold's the big dog. We're not going to get silver over $30 until gold joins the party. Gold right now is basically at $1,720 and was down $10 today. Is down trading near its low for the correction since August. And you're not going to get that. The retail crowd isn't really going to come in here until $30 silver. So yeah, gold has to join the party. Gold is the big dog. Gold leads. I call silver little sis. So big brother, gold, it goes first. And then little sis runs past him. She waits till the coast is clear. Once the coast is clear, then silver will outperform gold. And that's kind of what we saw here. So little history lesson. So gold and silver both peaked in 2011, and then they started down in 2013. So we went into this channel in 2013, and we stayed in the channel until 2019. So the summer of 2019 is when gold broke out. The gold bull market, it took off. It went above $1,400 in the summer of 2019. So we've had a gold bull market since 2019, about a year and a half into the bull market, and it's $300 above that. So we got a long way to drop down back in to get out of this bull market. Silver, its channel went from 2013 all the way to the summer of 2020. So its channel was 7 years long, and it broke out last year in the summer. So the silver bull market has been around for 6 months. So those are the two factors. That bull market is kind of, we've been in a correction now since August. So those are both we're going to go higher. They're both going to break out. They're not going to go back to where they were. Oh, by the way, I didn't mention silver broke out at 1850 back in the summer. That was when the bull market started for silver.
Right. So, Don, what are your considerations when thinking about putting money into gold and silver? Do you have any type of framework for allocations of physical gold and silver ETFs and miners?
Yeah, that's a big question. So investing in gold and silver, for me, I think of gold as an asset, not an investment. So I don't invest in physical gold. I invest in physical silver because I think that silver is going to go to at least $150. Gold, if gold doubles, what's 100% return? That's nothing. If you invest in a gold miner or silver miner, you're going to get 300% plus. But, silver, I think it's going to go to 150. But again, I talked about how the ETFs could get outlawed. And if that happens, we might not make it to 150. But we should definitely make it to 75 or 100. So I still think of silver as an investment. I used to always tell people the key number for silver is $18. You want to get in before 18. If you get in before 18, you're not going to lose money. It was always my feeling. It's like 18 was like, for some reason, that was the floor for me, or the ceiling. That's where I wanted to get in. So if you're buying at 28, you're a little high. You would really want to buy around 22 and 23. You might get a chance here. So if you're buying physical silver, now the problem is for buying physical silvers, the premiums have really exploded. I was buying 10-ounce bars with the premium under $15 not too long ago. Now with a premium, you're paying $32, $33, $34, $35 for a 10-ounce bar per ounce. But if we get back to 22, which I think is a possibility here in the next few months, we might not get there, but I think that's kind of my floor, 22. I don't think we're going to 18. You get to 18, you want to load up. That's kind of an ideal place. The premiums are high. I don't think the premiums are going to come down. You have to look at, it's still a decent buy, I think, around 22, 23.
So what are your considerations around the SLV versus PSLV debate? And what is the difference between an open and closed-end fund?
So a closed-end fund doesn't grow in size. So a closed-end fund it basically gets traded. And so the premiums go up and down depending on how many people want to own it. Now, open-end fund, for instance, SLV is open-ended, meaning that on a daily basis, if people buy more than, let's say we start today at PSLV at 600 million ounces. If more people buy ounces today, then SLV they have to go out on the market and buy physical silver. If it goes below the starting point, then they sell silver. So it's dynamic. They either add silver or decrease silver on a daily basis. And a closed-end fund, which is PSLV, it's stagnant. That basically stays at the same size, and then the amount of silver in there, they're basically called units. So the units is valued on each ounce that they have there, and the unit prices will go up and down. And in theory, if there's a lot of demand, then the premium will go up. And so if you buy now and there's a lot of demand, you might get a premium. And then the premiums usually never go below neutral or whatever. I think they were negative like last week on PSLV, which kind of blew my mind. Now, PSLV is a closed-end fund, but they added a whole bunch of silver. So they've been adding. So a closed-end fund can expand, it can add. And that's what PSLV's been doing. So it's kind of confused people. I'm glad you asked that question. It's like, wait a minute, PSLV's adding ounces. We need to buy a PSLV because they're buying silver. Well, once they get all the silver that they requested, so they have to go in to regulators and say, okay, we're going to add 100 million ounces or 50 million ounces. Once they buy that 50 million ounces, then it becomes closed again. Then it stops growing, then it goes by the unit basis. So they still have a few more ounces to add, but once PSLV adds up to, it'll get back to where it doesn't grow anymore. By the way, PSLV is much safer than SLV because PSLV is run by the Sprott Fund, and it's Eric Sprott's company, and we can basically know they have the silver. Whereas SLV is run by BlackRock and JP Morgan. And can we really trust those guys? Probably not.
Yeah, it seems to be a great indicator for which one you would rather pick, right?
Yeah.
So you recently released a great video on your YouTube channel entitled Investing in Gold and Silver Mining Stocks. And it's almost 3 hours long. It really takes a deep dive into investing in mining stocks of all types. And I really encourage everyone to go check that out. So on your website and in the video, you have a great breakdown of what you call your GSD or gold stock data categories for mining stocks. And in that table, you break down and define stocks in this space by market cap and also project type. So where do you feel most comfortable investing in those categories, and which one do you feel has the most leverage for investors?
It's a good question. I'll definitely answer that. But before I answer that, I want to say something about the 3-hour video. So a guy contacted me back in September, and he wanted me to do a video presentation of how to invest in gold and silver, and then he was going to sell it. And then it didn't happen. So I created these PowerPoints of this presentation. And so I said, what the hell? I'm going to give it away. So that was basically a 3-hour presentation on how to invest in gold and silver. And it's really for newbies. It's for beginners. It basically teaches you how to invest in gold and silver mining stocks. So if you're new to this, those videos are free. They're on my YouTube page. They're easy to find. Just find my YouTube channel, Don Durrett, and you'll see them at the top. Now, which category do I like the best? And there's no doubt in my mind. Now, I invest in all of them, but my highest allocation is in mid-tier producers. And the reason why is because I think that is the best risk reward. And for me, my mid-tier producers are much lower. I create my own definitions. So I have a mid-tier producer all the way down to 80,000 ounces. In my opinion, once a company is mining 80,000 ounces of gold or 3 million ounces of silver, I consider them a mid-tier. And so my mid-tiers go all the way down to, sometimes all the way down to 50 million, but on average about 100 million all the way up to 2 billion. I don't go to emerging major until 2 billion. So they can go all the way up to $2 billion. So it's a pretty big range of a producer, say 100 million to 2 billion. But what I like about that category is these companies have a lot of growth potential, and most of them have a growth mindset. Because if you're a mid-tier producer, your mindset is, number one, to survive. And if you're going to survive, you better find more gold. You better find a way to grow, because the way that mines work is they're always depleting. And so there's like a fire underneath a mid-tier producer. I mean, they have to be motivated because, again, it's a depleting resource. They got to find another mine. So it basically focuses these companies to be kind of, highly motivated. And they tend to be growth stories. So it's much easier for a company, for instance, to grow from 100 million or 200 million to 1 billion than it is for a company to grow from 1 billion to 2 billion or 1 billion to 5 billion. Okay, the other thing that's nice about mid-tiers is they can have very good balance sheets, very good cash flow, very good growth potential. So when you look at these mid-tiers, you can just cherry pick and pick the best ones that you like. And the other thing that's fantastic about them is that if the price of gold or the price of silver goes up, these mid-tiers are going to do phenomenally well. You're looking at, I think an average return of 300% if this bull market has legs. And some of these are going to be, 5+ baggers. Quite a few of them are going to be 5+ baggers. As a matter of fact, I did an analysis on First Majestic Silver, which is a large mid-tier. I don't think they're emerging major yet. They might be an emerging major. But they actually printed out, when I did the analysis, as a 10-bagger at $100 silver. But they've taken off. At that time, they were only at $11. I think now they're up to They probably crashed today. I don't even know the price. They might be down to 17. They were up to like 19 not too recently. They ran quite a bit from that $11 mark. But when they were at 11, I had them going up to basically 10x, over $100 share price. That's what kind of leverage these stocks can have.
So how do you feel about like royalty and streaming companies, Don? Do you not necessarily focus on these because you have a fairly wide-ranging portfolio and you can spend a good amount of time researching and really figuring out which particular projects you want to invest in?
Another good question. You got some of the best questions. I get interviewed a lot. These are some of the best questions I've had.
Thank you.
So the one thing that people need to recognize with the royalty plays is there are a few issues. It's starting to get crowded. It's starting to become a crowded field. I mean, not too long ago, there was only like 5, 6, 7 of these things. And now we're up to 16, 17, 18. And we're adding them, 1, 2, 3, 4 a year now. So it's starting to become a bit of a crowded field. That's going to slow their growth somewhat. The only way these companies grow is, well, there's a couple ways they can grow. One is they can have projects that are getting built and they have these streams. So these development projects that come online, those can turn into growth. But, there's only like less than 5 mines come online every year. So new mines coming online is kind of rare. It just, it just doesn't happen. So the growth for waiting for new mines to come online, that takes a while. So a lot of times their growth can take a while. And then the other way they grow is to do deals. And they can do deals for existing mines. And they can get existing, like get an NSR stream and get, growth that way. But the growth for royalty miners, I think the easy parts behind them, it's going to be tough. A lot of them are highly priced. I mean, the average on a royalty is like 25x free cash flow. Some of them are 20, some of them are 30, but right around 25. So they're very pricey, if you will. So it's tough for them to, grow on a cash flow basis. So they're somewhat dependent on the price of gold. Now, that said, royalties, I think, are going to do fairly well because they have fantastic margins. I mean, you're looking at 80% margins. Their costs are locked in their contracts. I mean, most these streaming deals, like on silver, they'll like pay $4 an ounce for a fixed price for the life of the mine. So unbelievably, low cost, right? And gold is, like $400 an ounce. So they have these fantastic margins. So as the price of gold goes up, they're going to do well. Undoubtedly, they're going to do well, right? But will they do as well as some of the mid-tiers? I'm not so sure. I don't own any of the royalty plays, and they've done fantastically well. So maybe it looks like I wasn't smart not to own them. But the one reason why I never bought any royalty plays, and it's interesting because I've heard a few CEOs kind of push back on them, is for 2 reasons. One, I hate to say this kind of publicly because I don't like to step on these companies. I mean, these are people that are running these companies, but my personal feeling about it is, one, I don't think that on an overall basis how healthy they are for the industry. Now, I know they're healthy in that they help companies raise money and they get things going, right? But I would prefer that companies got their money from banks. When they do a streaming deal with a royalty company, it hinders shareholders of that company to a certain extent. I'll give you an example, for instance, Alexco. So Alexco, they have this streaming deal where they have to give 25% of their revenue to a streaming company, 25%. As an investor in Alexco, I'm going, ouch, that really smarts. And then as the price of silver goes up, if inflation goes up, they're locked in at a fixed cost, $4 an ounce, right? And so if inflation goes up, they're going to actually be mining that silver to loss. And there's a lot of contracts that are like this. And so that kind of gives me a queasy feeling about that. That's number one. I really don't want to say that publicly, but it's kind of how I feel. Mm-hmm. The other one is, and this one I think resonates with people. I think people can really understand this. I've been saying this one for a number of years. And believe it or not, a CEO of one of the companies, somebody mentioned, that I said this, and he laughed. The CEO laughed at what I'm about to say, and you tell me if it's funny. So once the price of silver goes over $50, how many companies are going to stop paying their royalties? Now, if you say 0, then you're with that CEO and you're laughing at me. But if you're with me, let's say that you're losing money on every ounce. Let's say that you're paying the cash cost to get that silver out of the ground is $10. maybe even 15. Let's say that we have inflation and you're only getting $4 back. So you're losing $6, $7, $8 an ounce in every ounce that you're producing in silver. Are you going to keep selling that silver to that royalty contract? I don't think so. I think what you're going to do is you're going to stop paying and you're going to say, sue me. And no, you're not going to say sue me. You're going to say, let's redo the contract.
Mm-hmm.
Let's redo the contract. It's not fair. And the guy's going to go, we're taking you to court then. That's a contract. You have to pay us. Well, sue me. I'm not paying you a dime. I think that we're going to see some lawsuits around these. Now, again, this is over $50 silver. So I'm thinking way out into the future here. But we could be over $50 silver next year. And what I'm saying also applies to the gold miners as well. So it's the same theory, if you will. And that's another reason I don't own the royalties is because I'm a long-term investor and I don't want to have, let's say, a 200% return in a stock and then it crashes the next day because some notice comes out that they're getting sued for, by this company for this and this and this. And then the stock goes down 25% in one day. That's an issue for me for the royalty company. I don't like talking about the royalty companies because, a lot of people love them and I hate to be anti-industry and, it's not a fun topic to talk about, but, that's how I feel about them.
Well, I appreciate your honesty. And it just goes to show there's risks with all this stuff. But you recently wrote a post on Seeking Alpha entitled Best Silver Mining Stocks. So do you think that this is the last chance to really load up on silver miners?
Yeah, I do. Because it's the last chance to load up to get 10 baggers. I've always invested in gold and silver as a one-time thing, a one-time bull market. It's a one and done thing. And once this bull market's over, it'll be time to get out of these things. This bull market is like a once in a lifetime type of investment, once in a lifetime deal here. And now we're at the very beginning of it. And that's why I say, yes, the last chance, because this is at the beginning. You want to load up at the beginning. The HUI is at 250 right now, and that is actually not cheap. I mean, you really wanted to load up below 200 HUI. So yeah, 250, I think we're probably going to get a chance. Now, again, there's going to be lots of money to be made, but I'm just saying as a comparison basis to like people that got in early, if you will. So when silver gets over 30, I think it's going to run, that's when it's going to basically take off. And so that's when you want to be in. You want to be in before 30 because, you don't want to get in at 45 and 50 because let's just take an example. Let's say Pan American Silver, right? So Pan American Silver, when we get to $50 silver, is going to be over $50 a share, right? Mm-hmm. So do you really want to be buying Pan American at 50? I mean, yeah, you probably are going to double your money. It's probably going to go to 100. It might even go to 200 maybe, but you have a lot more risk involved. Again, I talked about how the ETFs are probably going to get outlawed. If that happens, all your silver miners are going to get butchered, right? So you really want to make your run now. You want to make your money from 30 to 50, and then, you can take some profit off the table, but at least you got in, you got to experience that run. But ideally, you wanted to get in below 200 HUI. And I mean, really, really ideally, you wanted to be buying below 150 HUI. And there's a lot of people that did buy below 150 HUI. Now, I don't think we're going to see that again. I don't think we're going below 150 again, but that was really the opportunity of a lifetime. And, a lot of people that bought in March made a lot of money. There was a lot of deals, a lot of these optionality plays back in March. I mean, a lot of these juniors were trading as if the HUI was at 150.
Mm-hmm. Absolutely. So, Don, as we see governments around the world continue to print their currencies into oblivion, what do you think the risk of mine nationalizations are in countries like Canada or Mexico, for example?
Yeah, it's a great question. And so I think that the risk is going to increase for higher taxes, higher royalties, and nationalization going forward. I think we're okay, in the short term. But once this run starts, once this bull market really kicks into gear, I think we're going to see it kind of across the board in every country. Now, I prefer to invest in Canada and Australia. Those are my two favorite countries because I feel that their governments kind of treat their mining industries as if they were kind of national priorities, if you will, and not so much anywhere else in the world. Now, in the United States, I'm okay with existing mines already been permitted and all up and running already. But wow, is it hard to permit mines in the United States? It just takes, 5+ years. So, the risk really goes up when you invest in a mine in the United States and you're expecting it to get permitted, in the next year or two. Most of these projects take 5+ years to get permitted. Now, as far as nationalization goes, I think that Central America and South America, I definitely think that we'll probably see a little bit of that going on in a few countries. Mexico makes me very nervous. I don't think that Mexico can nationalize their mines, but you know what they could do is they could use a hybrid model, which is scare the heck out of people. And what I mean by a hybrid model is they could nationalize certain mines. They can nationalize the best mines, if you will. They don't have the manpower to nationalize all of them, but they could start small and then grow. So there's all kinds of risk involved. And so I'm overweight Mexico. I know it. I got to get out of Mexico. I got way too. The reason why is because Mexico has all the great silver mines. Mm-hmm. So I'm way overweight in Mexico, and that's something I need to sell some profits there and get out of some stocks in Mexico. But yeah, so you definitely have to be aware of that. But one thing that people need to really realize is that Canadian and Australian mines are going to sell at a premium in the future. So I'll give you an example. Victoria Gold today, I just looked at them. They're trading right now at 5x free cash flow, which is ridiculous. The investors are just clueless on what that mine is, how valuable that mine is. It's basically a long life, it's at 200,000 ounces now, and they're finding more gold. So it's a long life, 200,000 ounce mine, and it's getting valued at 5x free cash flow. I'm saying that it's in the Yukon, which is a great place to mine. So they're not getting any premium at all for Yukon, which is just ridiculous. And they're going to get huge premiums for anybody that's mining in Canada and Australia. So I think it's going to be a 20x valuation. So it's 3x its value, what it should be valued today, where it's going to be valued. So if you're buying it today, it doesn't look like it's cheap, super, super cheap, like I'm saying. But if the premiums happen the way I expect them in Canada and in Australia, I think Victoria's going to trade at 20x free cash flow myself. And so if the price of gold goes to 2,500, you do the math. It's right. Cheap today.
So what happens to shareholders in that case if they do get nationalized, Don?
Well, that's a good question. In the past, we've seen the shareholders get completely screwed and they get zero. It's hard to predict. I mean, we saw that in Venezuela. Basically the stocks went to zero when Venezuela nationalized their mines. So that's the reason why gold and silver mining is so risky. It is so risky because you could have a stock in a country, they nationalize, and you can lose everything, 100%. It's like tomorrow. I mean, they basically what usually happens is the stock stops trading. It just stops trading, and then boom, you can't get out. Sometimes it'll go to the OTC, but it'll go down to pennies, and maybe it'll trade there. But it's got to scare you. The potential for nationalization has to make you nervous if you're a gold silver investor. But that's the reason why these stocks have unbelievable upside potential, because they're so risky. When you can make 100%, in a week. Last week, there was a company called Golden Lake, and it went up, I think, what did it go up? 300% in one day? One day, 300%. Oh. Where can you make those kind of profits? One day, 300%. And in some of these stocks, they go up, 100% in, a couple of weeks, a month, 2 months. So when you get those kind of returns, you're also going to have extreme risk. And that's what we're dealing with here. And it's always going to be a niche thing. I mean, not everybody's going to want to get involved in it. So the people that want to take a risk could do extremely well. Right.
Excellent, Don. Do you have any kind of concluding thoughts, or is there anything I missed as we wrap up here?
Yeah, I definitely wanted to mention one other thing. Let's kind of circle back to the beginning of the interview about how the price of gold is not really reflecting the economic situation that exists today. So what I mean by, I just want to reinforce this. For instance, Joe Biden is actually stopping something that's been in effect for 40 years. So when Reagan came in, I mean, you could say 35, but 35 to 40. When Reagan came into office, he did two things that fundamentally changed the economics of America. And those two things have been in effect since Reagan. So 81, Reagan came in, and 81 is when it really started. Those two things, one was free trade, but the other one, which is even more powerful that nobody really talks about, is supply side economics. Supply side economics really can be defined very simply. Supply side economics means that the government is going to help suppliers and not hinder suppliers. Well, who is a supplier? A supplier is basically any business that produces anything. You could produce a service, you could produce a good, any industry, any business is basically a supplier of jobs, right? Reagan, he put that in play. He put that in place. He lowered taxes. And he basically said, okay, we're going to do whatever it takes to basically raise the standard of living in America. But it was supply side economics. Okay, so Bush came in after him and carried it on. And then Clinton carried it on as well. Because when Clinton came in the early 90s, Newt Gingrich was in charge of Congress. And Clinton couldn't do anything, anything to change the economic system. So you had supply side economics continued. So in other words, Clinton did nothing to hurt any businesses. Then you had 8 years of George Bush Jr., and he continued supply side economics again. Then you had Obama. Well, Obama came into office right after the 2008 recession. So he could not attack business. So you had 8 years of a continued supply side economics. Then we had Trump for 4 years, and he continued supply side economics. So my point is we've had 35 to 40 years of basically do not harm business. Joe Biden is changing that. He's going to raise taxes on corporations to 28%, and he's no longer basically a business-friendly president. This is a big dramatic change for America, and he's doing it at the same time that we basically are in a recession. So to me, I don't see how the U.S. economy can kind of roar back to life and the stock market can keep going higher. This whole backdrop reeks of basically the United States no longer being the economic juggernaut that it has been since World War II. This is a transition, and gold and inflation and silver are going to show their face, I think, in the second half of this year. That's my expectation. So thanks for letting me wind it all up, because that's what I wanted to say today.
Of course, not a problem, Don. Talk about getting kicked while you're down, right?
Yeah.
Of course, we can find you on Twitter at Don Durrett, Durrett. Also your website, goldstockdata.com, and your YouTube channel under your name as well. Anywhere else you'd like people to find you?
No, and thanks for having me on, Tom. I appreciate it. It was a great interview.
Thank you very much for your time today, Don. Appreciate it. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.